It seems that just about anywhere you look at the moment, there's fear, uncertainty, and doubts on global markets. Whether it's publications, videos, or articles, there is enough fear at the moment to send any investor running for the hills. But I thought today it would be time for us to sit down, chat, and have a bit of a discussion about where things actually are. What are the known knowns, the realities that we understand in the markets, and what this could mean for us and where things head from here moving forward. As we know, up ahead, we're not far away from this U.S CPI inflation print that's been hotly anticipated. The market's eagerly awaiting to see where are we currently positioned. On one side of the coin, there's been discussions about peak inflation. Is there an economic slowdown up ahead? Well, on the others, there's fears about runaway and rampant inflation that may be even more difficult to curtail than was initially thought. There's so many macro uncertainties persisting at the moment. Volatility is back. I'm sure if you've been watching any of the global indices around the world, you've seen swings of 2, 3, 4% on the days. And this is happening far more consistently than you'd ever anticipate. If you do watch the crypto market, it's been a manic past few days there. And really, it all comes back together to the fact that there is a lot going on in markets with a lot of uncertainties and not a huge amount of answers at this current time. So what does this all really mean? What is the truth? At this stage, we're going to have to be data dependent. The reality is on markets, nobody knows where things are heading. And this is confounded by the fact that there's so many different uncertainties on a geopolitical front, on a supply front, on a demand front as well, and with the rising interest rate narrative. So we're going to have to continue to watch how things play out. But what do we know? There are some known knowns here, and it's worth us reflecting on them. We know we've got record high inflation, 40-year high inflation, which has been far more persistent than initially anticipated. We have had a relatively strong economy leading into this period. Of course, we navigated through the worst of the virus and the lockdowns with coordinated fiscal support as well as ultra-loose monetary policy, which is now slowly being walked back. And so there's uncertainties about how the market's going to operate and how the broader macroeconomic picture will look as these crisis time monetary policy settings are pulled away. But at this stage, we've got a relatively tight labour market. Many of the leading developed nations around the world have got a 3 or a 4 handle in front of their unemployment rate. We know that there is rising input costs, which are more persistent than would have initially been thought. We saw some of the insights with the Q1 reports globally. By and large, Q1 earnings season was probably about where we'd anticipate, if not slightly ahead for some sectors. But there was a lot of forecasting about the uncertainty into Q2 and ahead, the fact that inflation is here to stay, and also concerns about where will demand destruction come in. At what level will consumers be unable to continue to buy at the rampant levels that they have been, and what does this mean for earnings and potentially margins moving forward? We did see a surprise GDP contraction in Q1 in the US. Of course, this had a lot to do with inventories previously, as well as the trade imbalance, but it will be worth noting what happens moving forward from here. And it's not isolated to the US too, whether it's Europe with everything playing out there on the economic sanctions front. And then, of course, the implications for the supply chains further downstream from that. Or in China with the lockdowns and the potential to exacerbate supply chain concerns too. There are uncertainties in a range of different regions, and this is all feeding into that one discussion. We know that balance sheets have been expanded. We talked about the monetary policy support. If you're thinking about the Fed, they've got $9 trillion around on that balance sheet. They've talked about the unwinding and the QT commencing from June 1. And of course, a range of different central banks around the world are trying to ramp as quickly as possible, lifting those interest rates and hopefully trying to navigate that soft landing where they can curtail inflation, but not put the economy or an economic slowdown at risk, or worst case scenario, entering into a recession. So there's a lot to unpack, but we do know that liquidity is something that's going to become more and more into the forefront of discussion. Of course, as the balance sheets begin to contract, there's questions about where things are going to head from here. We also know that we had rampant valuations. They have started to come down as a cohort now, but how much further do they have to fall, if at all? It's going to be a fascinating discussion. This isn't a commentary on what will or won't happen, and what is and isn't worth paying attention to. Whether you're looking at the markets at any time, there's always something that's able to catch your attention. And granted now, there's a lot of different things out there. But it is important to stay as objective as possible. Feeding into the fear or irrational exuberance and excitement, it won't serve anyone well. We want to try and remove emotions as much as possible here and be as objective when considering anything on the markets. We know that pullbacks happen, retracements happen, heck, corrections happen once every 1 or 2 years. This isn't atypical. Markets don't go up in a straight linear line, and definitely when we consider the run that we've had over the past 5 years, but of course, most pronounced over the past 2 years out of those March lows in 2020. It was starting to get away from itself, and it's not surprising to see us slowly revert back to this mean, to see some multiple contraction across sectors, and it's going to be fascinating to see where things head from here and what this does all ultimately mean. In times like this, patience often can be the best superpower. While the sky is falling down, while there's fear abounding, often it can be prudent to look for the opportunities, whether it's opportunities on the market or opportunities to learn, to develop, and to grow. Of course, it's not always fun as you see things continue to head downwards in one-way traffic, but there is always opportunities to develop, and as the old quote goes, an investment in knowledge pays the best interest. Thank you for joining us. Here's another video on the topic if you're interested. For now, stay well and happy investing.